Welcome to Phil's gang. Well, it's interesting. We are now 10 weeks into the new year. And if you look back in 2023, everybody was all excited the S&P had a 23% gain. Now they're excited that in the first 10, 11 weeks, we have a 10% gain. But I don't know what they're getting excited about, because if you go back and look at 2023, if you pull the Magnificent Seven out, 7 stocks drove that 23%. So if you break it down, 6% was 493 stocks. Seven stocks drove what, 17%? That's insane. I mean, you talk about something that's setting up for a crash. Now we go into the first weeks of 2024, and you say, well, look at this, is great. They're doing good. We got a 10% gain. No, we don't. If you pull out the same 4 stocks of the 7, remember, no more Magnificent 7, there's 4 now. And if you take that 10%, 54% of the 10% was the same 4 stocks. You pull those out, there's no gain. So to put it simply, if we took the Magnificent 7 stocks out of 2003, out of the first 10, 11 weeks of 2024, there'd be no gains. But yet they're telling us this. Listen to this crap.
I think when you look at the broader data, the market continues, and the economy in general continues to be on good footing, right?
Good footing? The market, the economy? They're not on good footing. They're on sand. They're on quicksand. Remember, when we started this journey in the stock market in 2008, after we had the crash and people lost $8 trillion in value between homes and stocks, 10 million jobs were lost. There was a panic. And the banks, for the first time, got destroyed. And when Obama took over, nobody wanted to take the patience of rebuilding the stock market and the economy the way you're supposed to. Business investment. When you put money into new machinery, new equipment, and you start working on productivity. Productivity is everything. That's what drives the stock market, is productivity. But they decided to get rid of the productivity and swap productivity for this con job called QE, prosperity without profits. But now it's catching up. So here we are now, 15 years later, and they have no more room on their balance sheet. They're scared to death because they see a crash coming. But they've been able to put off a crash after 4 corrections. They're doing everything they can to make sure those corrections don't turn to crashes, because they don't have any money or any room on the balance sheet. Let me explain. And most people don't understand this. If you take a look at this chart right here, and I did this once before, the Treasury, remember, prints money, gives it to the banks, okay? And it gives it to the Federal Reserve. The Federal Reserve drops their interest rate from 5% down to 0. That's the fixed rate. And then the 10-year Treasury yield follows, and they drop their rates down to near 0. The important thing to remember is when the Treasury feeds the bank money, the central bank I'm talking about, Powell, he then takes the money and goes to the banks, and this started in 2009, it was under Bernanke, and he says to the banks, look, I will buy all of your treasuries, I'll buy all your mortgages, including the subprime mortgages, and I'll buy them for 100 cents on a dollar. They weren't even worth 1 penny. So all of a sudden, the banks are now flushed with cash. Well, where did all the garbage go? It came over here onto the balance sheet. So the balance sheet at that time only had about $850 million. It looked like this at the time, right about here. It's all had on there. So they kept on doing what they call QE. Money from Federal Reserve goes to the banks, buy their mortgages, buy their treasuries, puts it on their balance sheet. They take the money, go to the CEO of companies, loan it to them for zero interest, and they tell them, don't do any productivity, don't buy new equipment or machinery. What we want you to do is buy your own shares. So we can create an illusion that the stock market's going up. And this is Obama now, and this is what they did. It will create that illusion, and we'll get everybody very confident. We'll only do this for about 18 months. Well, that didn't happen. It's been 15 years. So we created this massive inflation because you have to keep printing money, and money printing is inflationary. So where do we stand today? Well, the balance sheet that you're looking at here is now filled. It's at the top up here, right there. So it's all filled up. There's no room. So what they're scared of is, let's say, and we're very close to this now. Remember, we've had four corrections, okay? And in those four corrections, remember, the market came down 2018, right? And then when it came down 2018, they stopped that correction, about 20%. And they turned around and they printed all this money and they came back in and they dropped interest rates back to zero and they pushed that market right back up. Then the same thing happened back in 2020. They pushed it right back up. So we had four of these. And every time we pulled back, they pushed it back up to where we are today. So they always prevented these corrections from going into a final crash. Now, let me show you. I mean, most people don't understand this, and they won't tell us the truth. They don't want you to know the truth. I'm going to give you the truth. So right here, take a look at this. Here's what I'm talking about. The minute this pulled back, they printed all this money, stopped the 30% correction, pushed it up, pulled it back again, printed more money, pushed it up again, started to crash again, another correction, stopped the crash. Remember, these were corrections that were stopped. They weren't allowed to go into a crash, in which we should then have a recession. And then when you have a recession, what happens is you get all this crazy valuations back down. I mean, stocks right now that should be trading at $50 are trading for $300 and $400. The inflation is created in the market. Now, they say they're fighting inflation, but how do you fight inflation? Think about it. The stock market went up 1,200% from 2008 to where we are today. The S&P went up over 600%. So moving forward, so you understand the reason why the market keeps going up and why you get frustrated. So, and this thing's never going to come down again? Sure, it's going to come down again. Of course it's going to come down again, but not now, because they're scared to death that they haven't figured out how to get off the balance sheet. The balance sheet's full. So if the market crashes, they can't start another rally. That would go into a depression. So they outsmarted themselves because they got greedy. So when the market, instead of going to 2008 and let the market go up and do their little trick, QE, prosperity without profits, for 18 months maybe, and then stop, and they go back to productivity, we'd be in great shape. But no, they all got greedy. Wall Street got greedy. In fact, then what happened was everything started to change where two banks started to control the Federal Reserve, Citibank and JP Morgan. They control 73% of the stock. So they're calling the shots. So Wall Street doesn't want a recession. Wall Street wants bubbles because the CEOs make a fortune. So the big scare now is we are going to get a crash, but can they unload this balance sheet before that happens? See, that's the big problem. And the answer is no, they can't unload this balance sheet. They can't push this balance sheet back down here. We're stuck up here. So there's no way to start another rally. They don't know what the hell to do. So what they're doing now, okay, is playing all these games with the economy, with everything. Here, let me explain. Take like for example, what they did in when they did the job numbers, for example, to make things look good. Okay, remember they came in with the job numbers, and they said, "Wow, you look at the jobs we created," and what do we find out? They weren't creating jobs. They were lying. They said they created 33 manufacturing jobs, 33,000 manufacturing jobs last year. We found out it was only 4,000. And who found out? The Philly Fed found out. They come in February, the first Friday of this February. Okay, they came in the first Friday of the month, February. They brought their job numbers in, and they anticipate we're going to have 190,000 jobs. They turn, oh no, gee, we have 275,000 jobs. Isn't that what? Everybody's happy in MSNBC, what a great president. But wait a minute. Then they said, oh, by the way, we got to do something. We got to take those January numbers that were 365,000, we told you. Yeah, we got to put them down to around 229. What? That's not a revision. That's a chopping. So those are the tricks they're doing so that this woman can come out and say what she's saying.
I think when you look at the broader data, the market continues and the economy in general continues to be on good footing, right?
What are you, nuts? Good footing. We're on quicksand. So now what happened is, now they revised down the 365,000 to 229. Now what happens is, what's going to happen in March? They said we had 275,000. They're going to come in and revise those jobs down. Now remember, they've been revising jobs down in 2023 11 times in a row. And why do they do that? Because like all revisions, remember what happens. They do it quietly. And nobody cares about the revision. There's no fanfare. There's no big thing on TV. There's not out in a newspaper. It's hidden. It's quiet. So all people hear is, look at how great the jobs are going. What that does, revisions in reality, it creates an illusion that the labor market is stronger than it is. So they keep coming out with big numbers. Then 2 months later, a month later, they come out and change it quietly. So that's how they're creating an illusion. And they keep saying over and over, the reason our country's so strong, the market's so strong, the economy's so strong, because we have a strong labor market. We don't have a strong labor market. We got a terrible labor market. In fact, people right now, they're not getting paid enough. 20% of the folks, they're taking 20% of their pay for food. 20%, they can't do that. People are now, for necessities, reaching in their pocket and grabbing $9,000 more than under Trump. So everything they're paying for over a 12-month period, it's costing them $12,000 more over 12 months under Biden than it did under Trump. But people that when they dig in their pocket for that extra $6,000, for the extra $6,000, they don't have it. So they put it on their credit card. And look at the credit cards. The credit cards are historic debt. Over 54% of the people aren't even paying their credit cards off in a month. They're just rolling it over. So that's what they're doing with the job numbers. And then, as I said, in the manufacturing, most important job, they've been lying to us all along, saying, we had 34,000 jobs, and we didn't have 34,000 jobs. And by the way, they got caught by their own Philly Fed. So if we move forward now with manufacturing, they're lying about that. They're lying about everything. So what we have to do right now is you're going to have to start learning to just stop loving these tech stocks, okay? You got to make sure you're staying with the stocks that have the strength, what we call relative strength. Because these tech stocks, as I said, if you go look, let me get rid of this. I love that chart. Tells the truth. If you go look at stocks, and you take the stocks like Apple's starting to fall apart. Tesla is falling apart. All these big tech stocks are all starting to fall. But look at Google falling apart. But look at J.P. Morgan. You got to start. There's other stocks out there, and you got to find these stocks with relative strength. If you want to join my gang for 10 days, it's free. We'll show you the stocks And these are stocks that we're in all those stocks. We were in Google and Apple and Microsoft. Right now, we've been shorting Microsoft. We're shorting a stock. Remember, you make money buying stocks, but you make fortunes shorting, especially when the market collapses. Now, I keep telling you the market is going to collapse, and it is. But what do they tell you? Right now, we're in what we call price 3 stage. What's a price 3 stage? There's 4 pricing stages to a stock. The third stage is the worst. That's at the very, very top. That's when you peak. And the reason why that's so bad is because when you peak, right here, let me show you. When you peak right there, see that? Stage 3, that's dangerous because it's all euphoria. I mean, that's a point where everybody thinks nothing can go wrong. The stocks are going to go up forever. And that's the point in which the big institutions, they start getting their people out. They start getting the unions out. They get their customers, like their clients, like the teachers union and the fire department and the police unions. They get them out. So what you do, what I do for my members is I start watching the volume. And what happens, you can catch when the market's going to start turning around on you because you start seeing the volume come in, but the pricing doesn't go up. Remember what charting is, price action. Charting is price action. And so you don't get the price action anymore. So volume increases, but the prices don't go up. That's what gives you the clue this thing is ready to give away because the institutions are not buying anymore. They pulled their bids out. They're not buying anymore. And then, so this is, and also this is, our pricing right now of our stock markets at the most dangerous point, stage 3, because then you get all these people who never bought a stock. They're saying, God, I missed out on NVIDIA. I got to get in now. He gets done, he hits his cell phone and he buys 1 share. He doesn't realize he could have bought that share for $5 in 2015. Now he's paying 11,000% more. He's buying for $900, but he doesn't care. He doesn't know what the hell he's doing. So this is the worst stage in the world. That's where we are now. So this is why they're worried. And this is why they're not telling you the truth. We're at the worst stage, the most dangerous stage, because this is where all the, again, confidence is and euphoria and nothing can ever go wrong and the market's not going to go down again. And that's exactly, remember, markets always do what they're supposed to do, but never when they're supposed to do it. And this is the area that you've got to be really, really worried about because remember, 1929, we had the crash as stage 3. 1987, that crash was at stage 3. The dot-com crash was at stage 3. The financial housing crash was at stage 3. They all start at stage 3. We're at stage 3 now. Now, as I said, they're covering it up because every time the market gets ready to crash, starts correcting, they print more money, come in again, increase money supply. But again, what happens, I'm going to show you again, make my point. Once you increase that money supply, what do you do with that money supply? You keep on taking that money supply to Fed, go to the banks, buy their assets, put it on your balance sheet, and now they're filled with cash, and they go and give the companies money near free, but it's not near free anymore, is it? No. Because remember, we stopped with QE. And so, and remember the banks went broke. Remember the 3 banks went broke? And why did 3 banks went broke? Because remember what happened? They were buying treasuries at real low rates, and they're saying, oh, look, I can buy a treasury at 1%, and I can make 3% on it. But then all of a sudden, rates went up to 5%. So you had the 3 banks go broke. Behind them, you got 180 banks going broke. So what they do? They set up this bank funding program, where what they're doing is they've been feeding all these regional banks around the country and making sure that they can pay their customer. When their customer comes in and says, I want to take my money out, I want to buy a treasury, that they got money for them. So these banks, what they did last week, this program shut down. But what they did, it was really quiet. They said, here, what we're going to do, we're going to shut you down, and, but you don't have to pay us. We're going to move you now over to the window, to the banking window, and you can get your money from there. And here's what we'll do. You know, the $9 trillion in commercial real estate that's due you guys, and the people that owe you that money, they can't pay you. You got to make deals with them. Well, go ahead and make deals with them now, because we're in an election year. We don't want you guys going down. So and nobody talked about this last week. So they did is put their thumb in a dike. So we got 180 banks that are insolvent. 180. And so they're propping them up by just shifting them from the bank program. Shut that down. Here, come to our regular bank. We're going to let you come to our regular bank, and we're going to keep feeding you. We'll just keep taking care of you. Oh, and your customers, you take care of them. Make deals with them. So everything is being propped up. But always remember, before I leave, the danger is right here. And this is what no one is talking about. This balance sheet is filled. There's no room. So that's why every time we get a correction, all of a sudden it rallies back up again. Because they know if they let a correction go to a crash, which used to be healthy, recessions were a healthy thing. Recessions, you reset prices. Like people are paying 20, 30% more for food. That would be reset back down 20, 30%. Gasoline would be back down. Stock prices would be at $350 a share, be back where they should be, $35 a share. That's why you let recessions happen as you go along in the economy. Yes, they're painful for about 6, 8 months, but you made sure things didn't get crazy. Now things are crazy. The prices are nuts. So we're just on borrowed time. So I want you to take a snapshot of this. And remember what I'm telling you about the balance sheet right here. This is the most important thing I think I could say about this whole deal. The balance sheet right now is filled. They filled it up right there. So I want you to remember this. There's no room, okay? There is no room. So what's going to happen is when the stock market starts to collapse and starts going down, they're going to do what? Nothing. There's nothing they can do. So when she goes down like this time, here, remember, every time it started to go down, right, what'd they do? They pushed it back up. Every time they did that, right, they pushed it back up. Went down, they pushed it back up. Went down, they pushed it back. At one point, they can't do that anymore because there's no more room on the balance sheet to go and buy their crap, put it on the balance sheet, take the money, give it to the CEOs. The CEOs keep buying their own shares to keep the stock market going up. That's coming to an end, and I'm the only one who's talking about it. So here's what you do. Between now and then, maybe this can go on for another year. I don't know. But I know there's going to be a crash. But until there is that crash, why don't you join my gang, try it for 10 days free, and why don't you be in the stocks we're in? Stop with those big tech stocks. You're going to get killed. Wait till those get discounted. In the meantime, look at the stocks we've been buying. We've been buying the banks. We've been buying oil. We're making a ton of money on those stocks. While everybody's looking to buy on the dip, buy NVIDIA on the dip, buy Meta on the dip. Everybody's buying on dips. What do you mind? All right. For more information, okay, on my charting, my stocks, our membership free for 10 days, check it out, philsgang.com. See you on the charts.